Is your money in a money market fund safe? That's the question that I want us to address today. My name is Pius Mushirimugo, the Managing Director of Nabu Capital. The US Security Exchange Commission was once quoted saying that investor losses are rare in money market funds, but they are possible. So what could terribly go wrong in a money market fund? Number one, there could be a large default, which could occasion losses for investors in money market funds. For example, investment in a commercial paper that where the issuer defaults could actually trigger losses to the investors. Governments also do go broke. Like, for example, we saw in Kenya, 52% of all the monies in money market funds are invested in government securities. So what would happen if the Kenya government went broke and was unable to meet their debt obligations to investors? That could be a crisis for the money market funds, and not just money market funds, but everybody else in the financial system. Another thing that could go wrong is if interest rates in the country would become so low that it would be impossible for the money market fund to recover the cost and leave some return for the investors. Money market funds are known to thrive in high interest rate environments. So when interest rates go too low, like in some markets, interest rates are at zero, then the money market fund as a product becomes unviable because it cannot deliver any return to investors. The third thing that could go wrong is a total collapse of the financial system. And we saw in 2008, the 2008 financial crisis, it occasioned some money market funds to actually go bust because there was flight to quality and people were withdrawing their money, and that caused losses to the investors who had put in money in money market funds. So those are three things that could terribly go wrong in money market funds. But again, I want to mention it is only on very rare occasion that happens. Why is it a rare occasion? Number one, money market funds are managed by investment professionals who wake up every day and their bread and butter is to invest and make money for investors. Unlike in any other financial institution, the core job of a fund manager or investment professional is to find the best and safest securities for investors. So that's one line of defense. The second line of defense for investors is that money market funds are regulated. In Kenya, money market funds are regulated by the Capital Markets Authority, and they keep a close watch, and there are certain stringent guidelines that all issuers of money market funds must follow. And because of that regulation, it brings me to the third reason, or the third line of defense, which is diversification. Money market funds are required to be diversified, and investors cannot put more than a certain amount of money in one security or in a certain class of securities. For example, unlisted securities, money market funds cannot invest more than 25%. So what does that mean? Why is this important? In case of a default, then investors cannot lose all their money. Unlike, for example, if you've put your money in a bank and the bank goes under, then you lose all your money. In this case, in a money market fund, it is impossible to lose all your money because one issuer has gone bust or the other. There has to be a total collapse in the financial system for you to lose all your money in a money market fund. So money market funds are considered to be safe. Only cash in the bank is considered to be safer than that, or cash that is not invested. But money market funds are considered to be extremely safe and low risk. And I hope that is useful information for those people who have been investing in money market funds, or those people who are hearing about money market funds for the first time and are considering to invest in money market funds. I will be continuing with this money market series, so please click on that button, subscribe, and see you on the next video. Thank you very much.